Individual retirement accounts. Now we've got our traditional IRA, which you can think of like a 401k, but you're doing it yourself. You got a Roth IRA, and you've got non-deductible traditional IRAs. These are types of individual retirement accounts. So you're doing it yourself. Now you can do these generally, even if you're contributing to a 401k, that provide different tax advantages to help individuals save for retirements. We've got a brief overview of each type, the differences between them. So traditional IRA, it's a type of IRA that allows individuals to make tax deductible contributions. So you are making a contribution, not paying tax on the money now, but you will pay tax on the money once you get that money out and you retire at the age of 59 and a half. Now, income here is taxed as ordinary income throughout the entire exam. Classifications of income, super important. So make sure you know that traditional IRA distributions are ordinary income. For Roth IRAs, contributions are made with after-tax dollars. So you get paid by your company, it's in your money's in your account, you put it into your Roth IRA, meaning there's no upfront tax deduction. However, earnings grow tax-free, and qualified distributions taken after 59 and a half are tax-free. Now for these, there's pros and cons to each. If you don't think you'll have a lot of money when you're older, put into a traditional, because if you think your tax rate will be lower when you're at 60 years old, which for some people it is, they're just getting Social Security, pension, right? They're not making the big bucks at that age, that's fine. For Roth, if you think you're going to be making crazy amounts of money, boku dollars at that point, you're not going to get taxed later on. For me, I split it half and half. Who knows what my future is going to look like? That's not tax advice. I'm not telling you what to do, but that's just a great way to visualize what's the difference here. So for Roth, also a great way to remember it, Rothschild, rich, wealthy, right? So if you think you're going to be wealthy when you're at retirement age, you don't want to pay tax on it then. You want to pay tax on it now while you're still working your way up the chain, up the food chain, and making those big bucks. So that's how I kind of remembered that. And then we've got a non-deductible traditional IRA. This type of IRA is used when an individual's income exceeds the limits for tax-deductible contributions to a traditional IRA. Like we said before, we do have income limits for these, which we'll have to memorize, and those will be in our resources. Contributions are made with after-tax dollars, but earnings still grow tax-deferred. Distributions in retirement are partially taxed, with only the earnings portion being subject to tax. Dive even further into our individual retirement accounts. Now, these contributions are going to be subject to an annual limit, meaning you can't just put all the money you make. I mean, well, maybe if you don't make that much money, but you can't put every single dollar. There is a contribution limit, which you cannot put over that amount. Any amount over that, you're going to get taxed on. Depends on the contributor's earned income. Now, in this context, earned income refers to the money an individual receives from working or providing services. What are types of earned income? You should know these. Wages, salaries, and tips. That's pretty straightforward, right? Makes sense. Commissions, also, if you're a salesperson, you make commission. That is going to be earned income. Self-employment income, any sort of Schedule C income you get there. Taxable alimony and separate maintenance payments. Now, if you've got any sort of alimony from before 2018, that will be included as well as earned income. And then lastly, non-taxable combat pay. So this is specifically for military pay, specifically designated as combat pay, and not subject for federal income tax. I'd say you're probably earning that for sure if you're out there in a combat zone. Types of income that are not considered earned income for IRA purposes. Basically, all of these are passive income. So we see here the types of income that go towards you being limited to contributing to an IRA are items of income that you are going to earn. You may disagree with some of them. I don't know. These are the IRS rules. And these are generally passive income. So this is not going to be included in the amount that will prevent you from contributing to an IRA. Now, the annual limit depends on the individual's earned income, age, and the type of IRA. If the individual has no earned income or their earned income is less than the annual limit, they can only contribute up to their earned income for the year. All right, let's see an example here. Individual retirement accounts phase out. Let's assume the following scenario. We've got the annual income limit is $6,000 for individuals below 50 years old. There is a catch-up amount, which you can memorize as well for those who are above 50 years old. Government saying, hey, you're getting up there. Let's help you. You can contribute more to your retirement. Now, this amount is what would change year to year, but for the year in this example, we're saying it's $6,000. We also have our contribution phase-outs. We've got the modified adjusted gross income phase-out range. For this year is 125 to 140. So if you make below this, you can contribute up to 6,000. If you make above this, you can't contribute anything. If you make somewhere in between, that's what we're gonna dive through. Here we see that John's a 35-year-old single individual with a magi of $130,000. What is John's reduced Roth IRA contribution limit using the phase out formula? So first off, how much over the limit are we? Well, 130. Lower limit is 125. We are over by 5,000. Now this follows generally how our phase out example in the beginning of the lesson worked. What is our difference between the phase out amounts here? This is going to be $15,000. So we're making 5,000 over the limit, $15,000 till we're totally phased out. So that's 1/3 or 33.333. Always love it when you get those numbers. Now we're going to calculate the reduction in John's contribution limit. So we're going to say that 6,000 is the total limit. 33% multiplied by that, we get $2,000. So now what is your reduced contribution limit? You can only contribute up to $4,000. That's how it works. Nothing crazy, nothing you can't handle. In this example, John's Roth IRA contribution limit is reduced to $4,000 due to his income falling within the phase out range. Nothing too wild. You can handle it. I have all the confidence and faith in you. May the force be with you. Let's move along forward. All right, dealing more, we're drilling this to death, right? I mean, there are a lot of points that I'm reiterating. There are a lot of new points as well. So keep in mind for these retirement accounts for contributions. Now, traditional contributions may be tax deductible depending on the individual's income and whether they're covered. Generally, yes, these are tax deductible. Generally, these are not tax deductible. These are after-tax dollars. We've got those maximum contribution limits. Those are going to be the same for our IRA types. And then non-deductible traditional IRAs. These are made with after-tax dollars and are not tax deductible. The contribution limits are the same, so contribution limits are all the same. Now, if you're over 50, you do have that increased amount, which again, do remember that as well. For distributions, for a traditional IRA, distributions are generally taxable as ordinary income. However, withdrawals taken before age 59 and a half may be subject to a 10% early withdrawal penalty with some exceptions. So one exception you'll see is there's a $10,000 amount. If you take out $10,000 prematurely from your retirement account and you put it towards a first-time home buyer, that is one exception you'll see where you're not charged the penalty on that. And then if there are various situations, the economy goes kaputs and is not doing too well, sometimes the government might say, all right, you can withdraw from your IRAs at this point, and you probably need the money because the economy's not doing well. But obviously that's not going to be on the exam. That's just kind of for some real-life context. For the Roth IRAs, any qualified distributions is going to be tax-free. To be considered qualified, the distribution must be taken after age 59 and a half, and the account must have been open for at least 5 years. Non-qualified distributions may be subject to taxes and penalties on the earnings portion. You're not going to get taxed on the initial contribution. That would be kind of BS because that was taxed already. And then non-deductible traditional IRA. Distributions here are partially taxed. The after-tax contribution portion is not subject to tax, while the earnings portion is taxed as ordinary income. We've got some examples here. So first off, for our traditional IRA, suppose you contribute $5,000 to a tax-deductible traditional IRA, and your marginal tax rate is 25%. You'd save $1,250 taxes up front, which we get by saying $5,000 times 25%. If the account grows to $10,000 by the time you retire, you would pay taxes on the entire $10,000 when you take the distributions based on your tax rate at the time of withdrawal. Now, just to beat this again to death, if this is confusing, if you've only ever done a 401k, well, the money is taken out by your employer, so you don't really worry about it. It's not like you have to put that in your tax return anywhere. I mean, yes, it does get automatically pulled from your W-2, but if you have a traditional IRA, there's no one there to take the money from you pre-tax. So what happens is you do put post-tax money into the account, and then on the face of the 1040, there's a place where you put what were your deductions, what were your contributions into the traditional IRA. And that's where you get a tax deduction. So basically, logistically, like just thinking about that, I love thinking about things logistically. How does it actually work? For all the IRAs, if you're doing it yourself, again, there's no one there to take the money out pre-tax for you. It's just you. It's individual, hence the name. So you're putting that money in. So if I take $3,000 and I put it into a traditional IRA account in Fidelity, and then I take $3,000 and put it in a Roth IRA, those are both amounts just taken from my bank account, which is all post-tax money, right? If it's just sitting in my bank account. However, on TurboTax or on the 1040, I'm going to report, hey, I put $3,000 into a traditional IRA. That amount will reduce my taxable income. Now, also for information purposes, you are required to disclose how much you contribute to a Roth IRA, but that's for informational purposes. The IRS just has you do that anyway, but that does not have an impact on your taxable income for the current year. That is how that works logistically. I think it's just helpful to understand how it works. Now, if you contribute to a Roth IRA with that $5,000, there's no upfront tax deduction, so you don't save on taxes initially. However, let's say the account grows to $10,000, you withdraw the entire amount tax-free in retirement, provided it's a qualified distribution. Sounds like a pretty good deal to me, but as we know, there are a lot of limits and rules and all that as we've discussed. For our non-deductible traditional IRA, suppose you contribute $5,000 to a non-deductible traditional IRA. There's no upfront tax deduction. If the account grows to $10,000, you would only pay taxes on the $5,000 earning portion when you take distributions in retirement. So we see here how this is kind of like, you call a hybrid. You're paying taxes on just the earnings there. And that is it. Got some good examples. Keep moving along.
Hey there. Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material. We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.